Welcome to the Treasury Update podcast presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in. On this episode of the Stories from the Front series, host Craig Jeffery joins Joe Dodi, Vice President and Treasurer at Health Partners Plans, to discuss the implications of the Federal Reserve's actions on investing and borrowing amid the COVID-19 pandemic. Topics of discussion center around operational and financial changes, with a focus on short-term investment activity, market shifts, and bank agreements. Listen in to this insightful conversation to find out more.
Welcome to the Treasury Update podcast. This is Craig Jeffery. Today's episode is Implications of Fed Actions on Investing and Borrowing, and this is part of our Stories from the Front series. I'm here with a longtime friend, Joe Dodi. He's VP and Treasurer at Health Partners Plans. Welcome to the podcast, Joe.
Thank you so much for the invitation. And Craig, 17 years you and I have known each other. I certainly couldn't say no to you today. So it's a pleasure for me to be here, truly. I mean that.
You're a busy and active man, and I appreciate you sharing some time, with me and then also with a broader audience. Before we get into the Stories of the Front, where we look at this concept of leading, through crisis into recovery, and just some of your experiences there, I was wondering if you could give us an overview of Health Partners Plans, and I'll say HPP if that's okay, just so that people know what your company is and have some background in it.
Yeah, so Health Partners Plans, or HPP, as we're known, is a Medicaid and Medicare health insurer. We are the largest Medicaid provider, and we have a business, a Medicare business as well. We are basically Philadelphia, so Southeast. We are known in the city of Philadelphia. We cover a lot of Black and brown people who need our services, and we actually recently have an opportunity to potentially expand in Pennsylvania. So we'll see, and have some ambitions to also do business in Jersey and Delaware as well. But we have about 800 employees or so.
800 employees, and how many people are you covering through your plans?
Good question. About 245,000 people. That was a very good question, Craig. That was a big surprise, but I'm glad I have it in my head.
I sent you a rough outline of what I might ask you. I didn't say I was going to cover everything.
Yeah, you can put that one on that list.
Excellent. So just in terms of your career overview and your current role, I've known you through several different positions in 17 years. I would have guessed it was maybe 19 years, but that sounds about right.
Yeah, that's about right.
You said it so firmly. I'm like, it's got to be there, and he's got me tracked on that. But maybe talk to us about quick view of your career, and then some of your current roles.
Sure. So the quick view. So I have been in 5 different industries, of all things. I've started out as a treasury analyst. Actually, before the treasury analyst position, I was a fund accountant at Putnam Investments. So I got the bug in investments. There, learned all about bonds, etc. there, which I later on had to use in my current job, believe it or not. Pricing mutual funds and pricing bond instruments. You have to understand what's going on in the capital markets. So from Putnam, went to a publisher, Houghton Mifflin, which is still around. Started there as a treasury analyst, and then from there, that is where I learned treasury. I finished there as the assistant treasurer. I helped build the treasury department from a department of basically the treasurer and myself. At that point, he wasn't the treasurer; he was a treasury manager, and then we got bought out in 2002, and moved my family to New Jersey. My kids were about 6 and almost 2 at that point. into aerospace defense, to chemical company first, and then aerospace defense. And finally, the last few years, I've been in health insurance. That I started at the Horizon Blue Cross and now at Health Partners Plans. So that's, but the Treasury is Treasury. It's the same. You have to understand the industry, but it's really the same pulls and pushes that happens.
Different volumes and some complexities, but there's the core is the same. Very, very interesting. Yeah, we see so many careers covering different companies, and thanks for that background. And what's your current role at HPP? And I know I know on LinkedIn you just took on some more board responsibilities. So maybe you just give us a view of your current role.
Sure. So my role, I'm still the vice president and treasurer for HPP, which comes with oversight of investments, insurance, and treasury operations. And recently, I was given the opportunity to be the chair of the foundation for HPP. So it was a total honor. I was the treasurer for the foundation, and typically the chair of the foundation is a direct report to the CEO. So this was a big deal for me to get this opportunity. I've been on the foundation 3 years, 2 years or so, and we get in the community, we give scholarships. I'm passionate about it, and I think they felt because of that, they wanted to give me the opportunity to lead the foundation as the chair. I do have an executive vice president and president of the foundation, executive director, I should say, and president of the foundation, who does most of the heavy lifting. She's actually in the community more than I am.
Well, excellent. Well, congratulations on that too. I know you're, like you said, you are actually passionate about those items versus some people use the term passionate for everything, but you are passionate and enthusiastic, and that's excellent. So now just shifting some of that from the career and about HPP over to this idea of coming through recovery, and maybe we should start back with COVID-19, the shutdown, when everyone moved to working remotely, work from home. What happened to you and your team in the beginning when everyone went home?
So initially the thinking, well, let me say, our leadership made some really quick decisions. And initially I was thinking we're only going home for a couple of weeks. But
we all did.
We all did. I know. So
home 2 weeks, we'll beat it, and then we'll all.
Yeah. So we, the shutdown. We were home before the shutdown actually happened. So we moved faster. The good news is the organization has some really strong business continuity in place. So in terms of the treasury and finance team, it was we kind of opened up the business continuity plan. And we had implemented a process to make payments for accounts payable without being in the office. So we as a team had just completed that a few months before. So it worked out perfectly when we went, when we all had to be in the shutdown. So we've been moving relatively well. The claims payments that we have to make as an insurance company, we basically, as we collect money and we pay basically 88 cents on a dollar. We have to, everything goes out. And so the claim side, we already had a partner that did something similar like that for us, right? And then the AP side, we did, like I said, a few months back. So everything was fine. Money was moving, people were getting paid, invoices were being sent into an email address. We're very, very functional in terms of operations. The bigger issue was what's happening with the federal funds rate and the impact to our short-term investments and such.
Yeah, so maybe you could shift into that. I mean, I love the example of the AP, the operational stuff. That's perfect timing, for doing that.
We got
had
lucky.
a number of conversations where people were like, "We've been pushing for 3 years, and now we got the buy-in because nobody can go to the office." So you beat that perfectly. But yeah, this concept on the financial changes, the Fed in particular, there was a number of actions they took, and there was actions in the market that perhaps precipitated concerns, impact on investments, and then some of their actions. Maybe you could talk about what you saw going on with short-term investments. What changed?
Yeah. So let me say, as an insurance company, we are really cash rich. We get significant payments from the state, so we have quite a bit of cash, and the short-term investment program produced quite a decent amount of returns for us. Then March came, and everything just went the other way. Literally, the prime funds started dropping, govies, government, and it's all money market funds mainly is what we invest in. So prime funds, government funds, and treasury funds. Specifically, we saw the yields drop about 150 basis points just like that. But one thing that we try to do is maximize our return. We were not afraid of investing in prime. We were not. So we focused on maximizing our prime position. And what I mean by maximizing our prime position is we have requirements from Pennsylvania investment rules, statute of limitations on how much we can invest in any one particular asset. So it can be more than 5% of your net admitted assets. So in any one fund. So we're using multiple money market funds, prime funds, maxing out on our limitation or a little bit below it. And then the treasuries and the govies, and also bank deposits. There's a fund out there, I won't mention the name, but it did really, really well for us.
Let me just ask you a question on a comment you made. You said you weren't afraid of prime funds, and there was quite a few people who got concerned when there was, some of the markets were freezing up a bit. I mean, if you have enough cash and you can wait, there's no concern. But a lot of people moved out of prime to government funds or treasuries, or they moved to the most liquid form they could during the depths of that trough. And so what made you not so concerned about that?
All right, so let me rephrase. We weren't afraid of prime funds. What we did was we didn't run out of them right away.
Okay.
We basically kept our position, and I spent a lot of my time on webinars, listening, reading, everything compared to 2008, because I've been in this business for a long time, 20 plus years, as you know, Craig. And I was around for 2008. 2008, I ran out. I booked right out, right? 2020, it's more like, all right, hold your position, see what's going on. And in about, I would say I was fully back in. Again, I didn't draw out. I didn't get out. I just stayed where I was. And then I added, and I added. So hopefully that clarified. I just don't want people to think that we were not being prudent. And at the end, I'm still where I am after I get back in prime today. So again, I'm not afraid of prime funds. Once I realized that Fed action, the liquidity the Fed was providing, was the reason why I stayed. There was,
And that was the purpose of their action, right? I mean, just almost unlimited support for those. Okay, yeah, that makes sense. So that's some of the activity. What else occurred on the investment side? You've moved back. It's things recovered from that really quick descent in recovery, the support from the Fed. Anything else that you learned from that that time frame?
I think the learning is holding, I won't say instincts, but rather doing kind of bottoms up reading and understanding how the markets are happening and not getting emotional, and sticking with the investment policy, because the investment policy allowed us to be able to do what we did. Now you move forward to right now, we're talking single digit treasuries. 5 basis points. To the point where, and I'll be one thing I would recommend people to think about is look at your earnings credit, because I have put everything on the table. I'm leaving more balances in our bank accounts. I don't know depending on who your bank is. So I'm basically maximizing all our cash position using short-term, govies, treasuries, prime, and earnings credit. Just trying to make sure we're making the right decisions on all 4 fronts. So, but it's only going to get worse, right? We're going down to zero for all these money market funds. Oh, Lord.
Awesome. Yeah, so that was, so the being a big investor, HPP, had to navigate through those items in a, calm hand at the helm, helped you guys get through that. And then I know when we spoke the other day, you talked about, different types of bank agreements, right? There's the investment side, but there's also the access to liquidity, not through the, but through the debt market. So maybe you could talk about, what's been going on. I know you're renewing, or you just renewed your credit facility.
It's renewing as of tomorrow. So we've come to an agreement on the terms, but before I get there, I was going into this bank deal. So it comes to the 30th of every September. I was going into this bank deal going, well, Fed is down to, zero bound, right? Craig, they're zero bound. So I should be getting really a good deal now, right? It should reflect in my price. That's what I was thinking. Well, it was a very different conversation. And later on, I begin to understand why the bank priced things the way they price. So the structure went from, the spreads were the same. The structure in terms of unused lines was about 3 times what it was last year. And then there was an element of cash deposit on top of it. So right away, I'm having a conversation with the bank saying, why? Well, they're telling me they're afraid of zero rates. They wrote negative rates, not zero, negative rates. This is my banker, my credit banker telling me this, they think it's going to be negative rates potentially. And then the reality is the banks are not making any money, right? Because the yield curve is so horrible. And depending on, unless you're JP Morgan, who has, even they should be having some problems. If you have other trading business, then maybe you can make some money there. But, they don't even need the money. People are giving them deposits that they can't turn around and make money on. So at the end, this is the really first time I've seen such a banking structure of all the years I've been doing this. And I've been in investment grade to non-investment grade to kind of low-level investment grade. I've been in all different industries and ratings. But the deal is actually a secure deal on top of it. So anyways, at the end, I believe we got the best deal, because I also want to get some inside baseball from my network and such. We did get a good deal at the end. It's a 1-year deal, so we'll see what happens. We'll see what happens next year.
We just completed a really large research, a survey with a major bank, and one of the things that was interesting, and I'd love for you to comment on this, is that there was some cross currents for, I don't want to call it, what do I want to call it? It was, there seemed to be particularly in the U.S., an expectation of both corporate treasurers as well as bankers that there was more money available for credit, that it would be leaning more towards the borrower than the lender for availability, but there would be higher covenants and restrictions. You know, it would be much more closely watched. And I think maybe you could comment on that. Is that a exact picture of what you saw, or how would you nuance it?
Yeah, so because mine was not a covenant-based loan, I mean, basically on every quarter I just have to submit, a letter saying that everything is good, and then send my financials. I don't have any covenants. It was straightforward. It was more around making sure that the bank has the assets to deliver. I did reduce my sizing. I did reduce the size of my loan because we're thinking about some other creative things that I can't share here. But I feel bad for those companies who have to go through covenants. I do. Because depending on your industry, you know what's going on out there. I mean, it's bad out there. And I'll tell you, in my industry, in the insurance industry, things are good. Things are good. Because what's happened is elective surgeries are down. So we're actually struggling to meet, right? We're trying hard to spend than not, right? Because people are not going to the hospitals as much. And again, like I said, we have to spend 80 cents on a dollar. So we're doing some really innovative things to give money into the community to meet that threshold for food banks and et cetera. I mean, we're doing some really good things. Now, if we wait till the end, the government will tell us what to do with the money. But there are criteria in Medicare and Medicaid on who you can give the money to in order to meet your threshold. Does it make sense? Yeah. So think about those other companies who are not in my shoes under covenants. Oh, I could see. I mean, I can't imagine the structure they have to deal with. So I got it good, Craig. I got it really good. Hopefully I answer your question, but I wouldn't. I remember one time when I was in the chemicals 1 year, I was doing a bank deal. It's a horrible non-investment grade company. I was doing a bank deal, and I had to give up gold that we use as a catalyst, okay, to produce a product. So this is gold in a drum. I had to use that as security. That was one of the hardest bank deals I had to go through. Can you imagine? So I will hate to be in the chemical industry right now. I'll tell you that much. What they're doing.
That's good. Well, and I liked how you answered that and explained the situation. And it seems like it's tracking. I mean, usually when there's a shift, like it's moving towards the last couple of years have moved towards the lenders. Things have been tightening after a long run of continually moving towards the position of the borrowers, right? Less covenants, better cash. Everyone's like, no, we want to hold this to you. Well, I've got other people lined up to pay. And so it was getting easier. And the last 2 years, it's shifted, and it's this shift back to the borrower side is limited. It's there's plenty of capital, it seems, to go there, but like you were talking about, concerns about costs of unused lines, committed lines, uncommitted lines. What are people doing with those things, and whether you have covenants or just the different terms, the term sheets that come out, have more requirements than they did before. So there's plenty of cash. It's for many industries, it's better. For the majority of industries, it's better from that side. But the restrictions have amped up too. So it's not this everything moved to one side or the other. And that's interesting because we haven't really seen that. Even back pre 2008, it's like everything moved to one direction or the other. And now it's like, okay, there's a split, plenty of cash, but tightens on.
Yeah, it's not a liquidity problem. Like I said, there's plenty of cash in the system, but they don't want defaults. They who wants divorce? Nobody wants divorce.
Even more than normal, and they're concerned. So that's very good. Joe, thank you for sharing all this. I did want to, as you've thought about this move to work from home and hopefully a return to normalcy at some point in the near future and everything that's going on, and what are some thoughts as we look at this series of stories from the front? What did you learn, or what would you want other people to make sure they knew? That's a good question, and the learning for me, and I'll get personal with this one. I had to get used to working from home, Craig. I remember starting out in my wife's kitchen. She let me in there for about 3 weeks, and then she's like, "You gotta go down to the office basement, right?" and so she kicked me out. But she had an office in the 4th bedroom, so she was fine. But I thought I was temporary. I thought this whole thing was temporary. At the end, I found a way to do that, work from home. In terms of the main operations, we were very comfortable as a company. So there were no issues, payments were happening. I had to personally figure out how to work from home and be online and logged on all the time. So I figured that out. Looking ahead, we still work from home. We were supposed to go back September. Our CEO pushed it to January, but it's going to be maybe 40 to 50 people. My expectation is this is the new normal. As you know, I work out of Philadelphia, so it's a decent commute for me from where I live. I can see me in the office much less in the future, and I think that's how it's going to be. And because we all are productive, we're all productive, and so the office space will be most likely will shrink, most likely, and I think that's going to be the new normal for a lot of companies. But interesting times. No one saw this. No one saw this coming. Interesting times. Joe, thank you so much for sharing your stories from the front.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.